This is Benzinga Live with Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojasik from Trend Spider. We have a breaking news.
What is up, everybody? Welcome back to another episode of Benzinga Live. Happy Wednesday. Luke, it's Wednesday. You know what that means.
Hump Day. My favorite commercial of all time. Everybody close your eyes. Think back 15 years. The best, most memorable commercial that will stick with me until the day I die is the Geico commercial where a camel is walking around an office saying Hump Day.
Has it really been 15 years, Luke? You're gonna make me feel
sir.
old.
I think it was 2007. I'm almost certain.
You know what?
I checked recently.
Do you know what else made me feel really old? Yesterday, the St. Louis Federal Reserve tweeted. They said, "Millennials, you might remember the Sacagawea dollar coin." I was like, oh, God.
Of course we do. That was a big deal.
What do you mean, do I remember that? All right, but anyway, guys, we've got a packed show today. We're going to be talking about Jerome Powell. We're going to be talking about the latest and what's going on in the stock market. But before we get to all that, we've got a very special guest of honor hanging out with us backstage, David Meniane, the CEO of CarParts.com. Luke, I know you're excited about this interview, as am I, so I don't want to delay it any further. Let's go ahead and give David our special intro and bring him on the stream.
David, welcome back. Good to have you again.
What's going on, guys? Happy Hump Day.
Happy Hump Day.
Happy Hump
Thank you.
Day.
Happy post-earnings day. Let me ask you this. Do you, because you're an entrepreneur, right? You're more than like, I would say you're entrepreneur first, like public company manager second. You can tell me if I'm wrong, but that's how I've always read you.
You're absolutely right. And also crushing the enemy third.
All right, and crushing the enemy third. So do you like hate these earnings days where you have to do the conference call, you got to read through the press release and figure out what quotes you're going to put in there and all that sort of thing?
Listen, I like being in the business. I like, talking to our customers. I like being in the front lines. That's what I enjoy. You know, the earnings day is part of the job and it's 4 times a year. So I just go through the day and get after it and then get back to work.
And then you're back to work the next day.
Back to crushing the enemy.
Mm-hmm.
And for anybody who's newer to the show, I mean, you've been on a number of times, but for folks who are newer out there, do you mind just giving us a lowdown of the business?
Of course, yeah. So CarParts.com has been around for 25 years. We're a direct-to-consumer, online-only aftermarket auto parts company. What we do is we source quality parts, both collision and replacement parts and mechanical parts, bring them to our distribution centers, and then ship them directly to consumers. And what that does is it allows us to have high-quality parts at 50% of the price from brick and mortar.
Awesome. And so let's dig into the numbers. Q4, you put up 12% revenue growth. The year as a whole, I think, was a little bit better than that, maybe 16% revenue growth on a year-over-year basis. You also saw a significant margin expansion, it seemed like. Can you take us through that? I think when people hear about wholesaling type businesses, which I'm not necessarily saying that's what you are, but businesses in that category, margins are always a key worry. And can margins actually expand as the business grows? Take us through what's going on with margins, how you're able to drive improvements, what's coming down the pipe, etc.
Yeah, I'll tell you, Luke. I mean, fantastic year. 4 years ago we were less than $300 million in revenue. And we just executed $661 million in 2022. We went through an executive team transition. We opened 2 buildings. We extended our line of credit for 5 years, longer and higher dollar amount. We're cash flow positive. We're growing. We're seeing margin expansion. I think our team has done an exceptional job, especially in this environment. So, if I look back to 2022, I can say that it was an exceptional year, record year for us. 25 years in business, record top line, and record bottom line. So I couldn't be happier.
Congratulations. And let's talk a little bit of history too. When was it that you and the new management team basically took over and started transforming the business? How long has it been?
So we came in early 2019 and really refocused our efforts around the core business. At the time we had 17 different websites. Our business was going into multiple directions. And what we decided was to really focus on what we do best, which is importing quality parts, the full assortment of auto parts, bring them to our DCs and ship them as quickly as possible to our customers at the best price possible. And at the same time, building a great user experience for fit-specific parts, and consolidated all our efforts around one website, which is now carparts.com. So it's just focus on the fundamentals. And at the same time, on the financial side, is really focusing on positive unit economics, making money on every transaction, and getting our customers to come back through delivering a great experience. So it's just the basic building blocks of building an exceptional company.
Sorry about that, David. We had a quick technical difficulty over here.
Hey, no worries.
Did you hold the fort down for us? Okay.
Of course I did. I always do for you.
Always.
Guys,
he always does. David always does.
He's got our back. David's got our back.
100%.
Okay, David. So I know I'm hopping around a little bit, but just to get through this history lesson. So you took over the business in 2019, and that's basically where you moved it from, I would argue, a car part first business to almost like a technology first business, or maybe a logistics first business. What did revenues look like then, and what do revenues look like now?
So back then, the revenues were around $280 million. About 25% of those revenues were unprofitable. So we made a big bet in shedding all the unprofitable revenues. So if you look at kind of the core business was around 230, 240. And today, virtually all our revenues are profitable. So we went from 240, 250 to 660. At the same time, our gross margin went from 28% to close to 35%. And we had some debt. Today we have no debt. We had 2 buildings. Today we have 6 buildings. We've hired a lot of exceptional people. We've built some great capabilities around logistics, technology, and data science. And that's what you saw in the numbers that we reported yesterday. We've built what we think is an exceptional business. And, I think we're just getting started. I think the industry is ripe for disruption. It's a $300 billion market, and we're just getting started.
Yeah. And I want to get to the market as a whole in a second here. Before that, you've been talking about the building of the new distribution centers for several quarters now, and congratulations on pulling it off. Whenever we have these conversations, it's like, yeah, it's a great idea. Are they actually going to pull it off? Yes or no? We don't know. You did pull it off, so congratulations on that. I believe that was to solve the problem of how long it takes from when a customer places an order to when the customer is getting the part. Is that still shortening that time horizon one of the key priorities for the business? Or are you thinking that that's mostly solved and now you're on to other big priorities?
No, 100%. That is really kind of the key metric or variable that we're trying to solve is the click to delivery times. As soon as the customer places an order, we want to make sure that they get the parts as quickly as possible. So, we started with 2 buildings. Today we have 6. And ultimately, the goal is to get to 10 to 12 so that we can cover 98% of the country within 1 day. Today, we're 98% of the country within 2 days. But if you look at what some of the other retailers have done in other spaces, they're trying to get closer to the customer and having that inventory locally so that the customer doesn't wait. And I think for auto parts, it's critical. We want to make sure we deliver very fast delivery times.
Excellent. And David, you alluded to the market. This is you always give us good stats, and this is one of the things that got me interested in the business. Probably 2 years ago at this point, when you first joined us. Give us the stats on the market.
Yeah, the market is $300 billion. And the online penetration of that market is less than 5%. And what that means is the percentage of transactions that happen online is lower in auto parts than most other industries. So if you look at apparel, electronics, it's 15 to 30%, which means 1/3 of purchases for electronics happen online. When it comes to auto parts, it's only 5%. And so what I see there is an opportunity for companies like us to shift that. Imagine if the market becomes 6%, 7%, 8% online, that's billions of dollars. And that's what I think is the biggest opportunity for a company like us to go from 660 million to way beyond.
Yeah. And when you talk about the 95% are not made online, is that happening at like a local O'Reilly's, or is that happening at a mechanic shop when they're looking at your vehicle and say, okay, I'm going to give you these brake pads? Where are those transactions happening now?
It's happening in both places. So if you look at our brick and mortar cousins, most of them have 6,000 retail locations, about $12 billion in revenue. So that's a $50 billion total addressable market. What we sell is the same parts, significantly cheaper with our direct-to-consumer model. And then also at the shops where they buy from a wholesaler and then they sell it directly to the customer. Regardless, we sell the same parts, just significantly cheaper. So I think we have a great competitive advantage with our data science, with our technology, and I think the space is ready for some disruption.
Excellent.
Let me hop in here real quick, David. So, Luke's, the business guy. He knows how everything runs. I'm more the stock guy. Well, Luke's a stock guy too, but I'm looking at the stock. So, I back in November, car parts stock was below $4, and then just a couple months later, it went up almost 100% to $7.50. What do you attribute that positive momentum in the stock to?
I've been at the company for 4 years, and I remember seeing the stock at 88 cents and remember seeing the stock at $24. And, the last 12 quarters, we had like year over year double-digit growth. So our business has continued to grow. Our margins have continued to expand. We've built what I think is an incredible business. I think the stock market sometimes is a little slow to react. It's hard to say between crypto and NFTs and SPACs. There's just so much volatility in the market. I just focus on the business and delivering a great experience. And eventually, I think the stock price will reflect the true value of our company.
Got it. So the overall storyline of the market this year has been revolving around interest rates and the Federal Reserve raising interest rates. How have higher interest rates impacted the company? Because I'm curious. I mean, on one end, it makes it more expensive for people to buy and finance new cars. So you would think maybe that would incentivize people to buy some car parts and fix up their old car.
Yeah, I think one of the things I can call out is the way we think about building the business is that for the first 3 years, so 2019, 20, and 21, we were really focused on growth. When you think about building kind of intrinsic value for shareholders, especially in a rising interest rate environment, like the key point becomes free cash flow. And how do you grow, but profitably? So we made a pivot last year around just growth at all costs towards profitable growth. And now we're a lot more focused around operating leverage, free cash flow, continuous improvement. And we think that long term, like having the ability to generate that significant cash flow is what's going to make our stock much more valuable than kind of a multiple of revenues, if you will.
Mm-hmm. Yeah, absolutely.
So what are some of those steps from kind of taking, I guess the difference between growth at all costs to more focus on profitable growth? Like what are the tangible steps to make that transition?
Yeah, so if you look at our P&L, we kind of go through it line by line, and we're trying to find opportunities to get leverage, whether it's in transportation, in freight, inventory placement to cut back on the freight expenses, and then looking at warehouse labor, warehouse efficiencies, customer acquisition cost, trying to move away from kind of that discretionary marketing spend into more performance driven. And then at the same time is being very careful about fixed operating expenses, new hires and contracts, and being a lot more intentional about where we spend every dollar.
Got it. Yeah, I mean, I think that's in general, as interest rates have gone up over the past year or so, right? You see companies, like you said, more focused on the profitability, whereas in a low interest rate environment, you have the ability to kind of, just go after growth at all costs. So it's interesting to see you guys, be nimble, be versatile, and be able to change as the markets change.
Yeah, ultimately it goes back to what's your cost of capital and what's the return on invested capital that you're going to get. And if money is cheap, you can grow significantly faster. If money becomes more expensive, you got to double down on those efficiencies and build an exceptional business until the market turns. So for us, having those positive unit economics, being debt-free, being cash flow positive, that's a huge asset. And when the market turns, we're going to be in a significantly better position than some of our competitors that maybe don't have that financial resilience.
Got it. Luke, you got any final questions here?
Let's talk about the automotive market as a whole. It's one that's been volatile over the past 12, 18, maybe even 24 months. what are you seeing in the automotive market, both for new and used vehicles, and then how does that translate into your business?
What's interesting is, and you call it out every time we talk, it's the size of the prize. There's 300 million cars on the road today in the United States, and the average age of a car is 12.2 years old. Most people don't drive a brand new car. So in a difficult economy, they want to keep that car riding longer and longer. And what's exceptional about our business is that we sell a need and not a want. So if you're selling kind of performance and accessories, it's tougher in that environment. If you're selling replacement, brakes or suspension or lights and mirrors, you need those parts to keep your car running. So I think we're in a good spot. Now, obviously, the consumer is getting pinched, but the consumer is still spending today, and we see it. They're just a lot more disciplined as to where they spend that money and when they spend it.
Awesome. And David, last question I'll throw to you, maybe a tough one. What is the one thing you are most excited for 2023?
So what I'm excited is really the pivot that we made last year, which is putting the customer in the middle at the center of everything we do. Historically, we were so focused on the logistics and the technology and the data that we see an opportunity to really start and end everything we do with the customer. So this year, 2023, it's the year of the customer. It's where we overinvest and shift money from other areas of the business to deliver an outstanding customer experience and give them a reason to come back. That means better experience on the website, faster delivery times, higher quality parts, and just being there for the customer when they need us.
Awesome.
All right, well, David Meniane, thank you again for joining us on Benzinga Live. It's always great to have you. We got to catch up next time you guys report, or anytime you guys have any exciting news. Just reach out. We'll get you back on because it's always a pleasure to talk to you.
Awesome. Thanks, guys. PRTS to the moon.
There we go. Thanks, David.
All right,
I'm still in that stock too.
You are?
Yeah.
Yeah, I mean, I
like the story of the size of the market.
Yeah, I was just gonna say that stat is just still so insane that how big the auto parts, total addressable market is in general. But it kind of makes sense, right? Because most people aren't gonna order a new bumper and put it on their cars themselves. What people need to get better at doing these things at home, and then that will really drive car parts stock higher, I think.
Wait, say that again.
So right now, Luke, if something's wrong with your car,
yep,
you basically need to go to a mechanic, right? You could order the car parts off Car Parts and then bring them to the mechanic and say, hey, I already got this. I need you to install it. What I'm saying is if you and I took a crash course on how to do a lot of this mechanical work, then we'd be more incentivized to order the parts ourselves and do it ourselves versus just going to the mechanic and paying them.
Let's ask this to the chat. What do you do on your car yourself versus what you pay somebody to do?
Yeah, AT, come up and talk about it. Come talk about it. I change
What do
my
you
own
do?
oil.
You do?
Well, I have in the past. Well,
Okay.
Let me stipulate this real quick because I don't think I did a proper. I didn't do a proper oil change. I had an oil leak in my old car, and I would just kind of top it off every now and then.
Okay, topping it off. That's not changing your own.
Okay, but that's maintenance work if you ask me.
I
can change a tire. I changed a tire pretty recently.
Yeah, Jay Rice, fill it with gas and drive through the car wash. I'll change lights. I'll change a headlight or a tail light.
Well, okay, so that's one thing I will say about the headlights.
That's pretty much it.
Is American cars, typically it's a lot easier to pop open the headlight, put a new light in. My Toyota, or at least my old Toyota, they had to take apart essentially the whole
battery. I do battery myself too, Leo.
Oh, that's easy. Yeah, that's easy. That's easy. Battery replacement, that's good. So yeah, what if Car Parts did tutorial videos and stuff and got people more involved, or just or if more people knew that you can buy your own parts, bring it to the mechanic, and you can save money that way, because you're obviously getting upcharged if you go to, your local mechanic and they order from a wholesaler and then sell that part back to you. I don't know if most mechanics...
No, it's a decent... Yeah.
You see what I'm saying?
Buying it and paying somebody to put it in is a decent solution.
Oh, Jay Rice saying it's harder to do some work on your car because there's so many chips in the cars now. But the battery and the headlight, stuff like that. I mean, there's no reason, I guess, really to not...
My dad bought a car 8 months ago.
Uh-huh.
And we're now about to finish winter. Still does not have the chip for his heated seats. Isn't that crazy?
Wait, the new car came without the... Was a defect?
Oh, yeah, they're shipping cars. At least GM is for the past many months has been shipping cars without all the chips.
Can you guys hear me?
All right, wait. Can
Yeah.
we get the ceiling? Oh no, we don't.
It's okay.
Here, just come over here. Stand in front of it.
I'll stand over here. Bring in the mic. All right.
closer.
So here's what I'm going through right now. So we had a snowstorm, ice
That was
storm
my
in
deodorant.
Michigan about on Friday, and so
Here,
we
come
were
close. Come in.
we
more.
were driving. Oh wait, I'm gonna get caught in this mic.
Who's
so-
we, by the way? We're on a podcast. We don't have all the context.
All right. So me, my girlfriend, we were driving to a fish fry, and it was snowing. There was ice storm, stuff like that. She was driving, and the undercarriage of her car basically was gathering a bunch of snow and ice, and now it was hanging from the car and it was scraping from the ground. So we took it into the dealership. The dealership, we left it there for a few hours. They called us back and said they wanted $815 to replace this undercarriage part. So I was like, hey, can I get the part numbers from you? So he gave me the part numbers, and I went onto Audi's website. And they sell
You should have gone on car parts.
OEM parts, and so I ended up buying the parts myself for $75. I'm gonna go install it myself, so I'm gonna save over $700.
Wait, what part is it?
It's literally an undercarriage. It's
So,
like a plastic piece, but they wanted like over $800 just to buy the piece and do the install.
Have you looked into the installation though? Is it going to be tough? You're going to get fully like.
So
under the
I went
car.
under the car to zip tie it so it wouldn't scrape when we drove it to the dealership, and I saw that it's literally held up by 5 bolts. And I told the technician that. He still wanted that amount of money, and I was like, "Just give me the parts, and I will do it myself."
Well, there you go. Way to be resourceful, Aaron.
Yeah.
And also, congrats on the girlfriend. I mean, everyone on the show has a girlfriend except me. I don't know what's wrong with me. So, if anyone out there,
Little lonely.
a little lonely. Just kidding. All right. Well, Luke, do you have 3 minutes to rip through some stocks real quick? You
Yeah,
got a
let's do
jet.
some stocks. Come
All
on.
right, let's rip some stocks. All right. Off the top of our head, let's start with. Remember when we said we'd be either really dumb or really smart for buying Baba?
Yeah.
I think we're looking pretty dumb.
Pretty dumb.
Okay, well, but let's talk about all the new like risks that people are, with China and going on. Like, how worried essentially would you be in investing in something like Baba or K-Web or something right now about like the U.S. implementing new sanctions on China and all this stuff?
I don't think Baba is really viable.
Too much risk, right? All right,
I think China's going to sell artillery shells to Russia or
That-
Belarus or something.
right, and that's why that's what the talk is right now is that the U.S. is going to sanction China if it does essentially get involved in the Russia-Ukraine war and take Russia's side. The U.S. will implement new sanctions, and the idea is then the Chinese names like Baba, K-Web will continue to move lower if that happens.
Yeah. I mean, here's the positive though. I think is that here's my thinking. Gut check me on this, guys. Okay, so let's say Russia or China does sell military equipment to Russia. Stocks are going to get hit. Chinese stocks are going to get hit on that happening. U.S. is going to take a day or two to respond. They're going to get hit again. I think that's your buying point because I think that signals that China is also not going to invade Taiwan.
Oh yeah, I mean it's
I
basically
think it de-risks that situation.
it's basically is China going to be more focused on like the economy and business growth of the country or getting involved in these like geopolitical conflicts because they don't go hand in hand, right? You get involved in these geopolitical conflicts, your economy is going to get hit, you're going to get sanctioned by the US, their biggest trade partner, or they're going to say, "Hey, no, we're really focused on economic growth. We're not focused on this geopolitical stuff." I honestly I don't know. Like I've been wrong about China for the past year and a half, but I would still be surprised if we see China get involved like super heavily in the Russia-Ukraine war and then invade Taiwan. It just seems like what's I don't know. We'll see though. Again, I've been wrong on it. I'm willing to admit that. But let's move on from Baba and Chinese names. Anything else you've been watching? Anything else you're interested in?
Well, talk us through your biotech one.
Biotech? You
Yeah.
mean my energy one?
Your energy.
Okay, so this
Give us the two-liner.
EOSE. Okay, so EOSE, it's a very small cap energy, super highly speculative, high risk play. Essentially, EOSE has a patent on battery storage of renewable energy. So the big holdup with renewable for the past like 20 years has been any energy, that's collected from solar, wind, all this stuff basically has to be used right away. There's no way to store it. You can store fossil fuels, coal, natural gas, and now EOSC is addressing this problem. They have a patent that the Department of Energy allegedly really, really likes and is allegedly, I don't know, getting ready to maybe give EOS a big grant. And if that happens, this $1.94 stock will absolutely take off. And so my thing is just from a chart, like looking at it, like it looks like it's, kind of found its bottom. Like, I don't know how much lower than $2. I mean, I guess it was at $1 a couple months ago and it's at $2 now. So that's a 50% drop from there. But either way, like, I mean, the stock ran when every other clean energy stock was running in 2021, got up to $20, even got up to $30 back in the day. But now it's a $2 stock. I, again, am not like very highly convicted on this. I know some people that are. I am more saying I think this is from like a risk reward standpoint, something I'm willing to take a stab at.
It's an interesting story. So it's basically a binary event. It's whether or not it gets this government contract or not.
In the short term,
is it as
in
simple
the
as
short term, yes. In the
Okay.
short term, yes. But you got to remember, I mean, the Build Back Better, Inflation Reduction Act, all this. There's money out there to be had, and for these companies, it's specifically for like domestic energy companies. Both COVID and the Russian-Ukraine war have shown that we can't be so reliant on outside sources for energy. Right, when Russia cut off when we cut off Russian imports, right, it made gas prices go crazy. So this stuff, I think, again, it's super highly speculative, super high risk. It's not something I would even recommend. Like you're the only person I'd recommend buying. I'm not going to tell my mom to buy it.
Okay, it's a high risk stock.
High risk.
All right, no, that's sort of fun. Can we do story time?
Yeah, story time.
One of the worst SPACs.
Birds.
People throw out your worst SPACs. Birds is up there. That's a bad one.
19 cents right now.
That might be worse. I don't know. The one that I'm going to drop, and again, I want everybody's worst SPACs in the chat. The one that I'm going to drop has got a share price that's more than double that of Bird. But we should talk about Bird.
Okay.
But it may be a worse situation. It may be the worst SPAC.
I have no clue what you're talking about. Give me a hint. Give me an industry. Or does it give it away?
Gambling. There weren't many gambling SPACs, I don't think.
DraftKings was a spec.
Yep, it's not that one.
I know, because that one's way higher. I don't know. GMBL? Gambling.
That's an ETF, right?
No, GMBL is not an ETF. BETZ is an ETF.
That's an ETF.
Do you know Dave Mazda's at Round Hill now, by the way?
No, I didn't know that.
Yeah.
We need to give him a shout.
BETZ is Round Hill. And I just noticed that on Twitter yesterday. All right, I don't know. I should know this. Gambling. It's not, Penn, obviously. It's not DraftKings. It's not, Sports Radar or whatever. No? All right, you got to give it to me.
All right, ticker LTRY, lottery.com.
Oh.
All right, I spent way too much time going through this story over the weekend. It is a disaster of the story. The company does have a CEO now. But as far as I can tell, there was a period of time where there was no board members. I think there are still 0 board members.
Wait.
And there was also no C-suite officers. There was
a public company had no board members?
Well, it gets crazier. No CEO, CFO, president, CMO. Like, I think, like, it was like you ever heard of a ghost ship?
Yeah.
Like, it's these ships that just get abandoned for whatever reason. Something happened to the crew. They're just floating along.
Yeah.
I think it was like a ghost ship stock.
Yeah. It's like Pirates of the Caribbean. Yeah.
It's very, very tough to follow because you have so many. It's like a revolving door of people getting appointed shit and then quitting when they realize it's a disaster.
But it's okay. You looked into this company. You looked into the story.
I read the press releases for over like a 24-month period.
Is it does lottery.com work with like the state lotteries, or is it like private? You know what I'm saying? Does it work? Like, can you buy Powerball tickets on here? Like, I don't even know what it is.
Yeah, it's like enablement of gambling via technology, basically.
Ugh. Okay.
And they do own the URL lottery.com.
I do worry about like the gambling space in general, that over time, because okay, here's the idea, right? Is that people were gonna gamble no matter what. States might as well, get some revenue out of it and regulate it and tax it. But what I worry about is that now that it's become so prevalent And
Hey,
like,
see if you can go to lottery.com.
yeah, of course. And is it that big of a ghost ship that the site doesn't work anymore? Because that'd be here's a good rule of thumb. If a name of a stock is like the name and then .com, like GoDaddy.com or Lottery.com, and the website doesn't work, it's probably a short, right? So let's see if at least.
Share your screen.
Oh my god! So the stock's name.
I told you, dude. I'm an 80% conviction level. Okay, I'm not 100% certain, but as far as I could tell, there was a period of time where there were no board members and no executive officers.
The stock is literally
like a
called
ghost ship.
Lottery.com, and you can't go to Lottery.com.
It's not looking good.
No, how is it still double the price of birds? That should tell you something about birds, the business of birds, that it's still down. So birds.
Because I think it does own IP.
Okay, like the actual
Like the name
technology.
lottery.com, you can sell that for several $1 million. That domain.
That's the last asset they have is literally the domain name.
So what's the market cap right now? The market cap is 27 million.
Have people been covering this story that like literally lottery.com, you cannot access the website right now?
I have not seen it.
All right, we got to get on. I'm going to write an article.
Yeah,
about
they
that
did
today.
appoint a new CEO in the middle of February.
It says the enterprise value for this company is negative $20 million. How's that possible? Too much debt? How about this one, Luke? Rivian was down. All right, look at this. So
This is hilarious. So on February 15th, all right, this is like how tough it is. All right, February 15th, okay? Listen to this. Again, February 15th is when this was published, okay?
okay.
Lottery.com has appointed Mark Gustafsson as Chief Executive Officer and Principal Executive Officer effective February 1st, 2023.
Jeez. So they didn't even put out a press release until 2 weeks after?
I think they had to go backwards because the last CEO's last day was January 30th. Let's see. The CFO resigned, I believe, around January 30th as well.
Josh Bruder in the chat saying he tried too. The site isn't working. So it's not just me. It's not just my computer. The actual website, again, I just can't believe that the name of the stock is the website, the URL essentially, and it's not loading. Again, that should be...
Okay, no, they do have a board member.
Oh,
now.
Wow. They're legit.
Let's see. Let's look up this guy. I want to see if it's like a wind down person is my guess.
Oh, what about Jay Rice brings up a good point. What about HOFV? Where's that stock at, you think? I'm not going to look at it. You remember HOFV? Do you remember what
Hall
it is?
of Fame Resorts?
It's literally the NFL Hall of Fame went public.
No. No, it's not.
Well, kind of. Not literally. Sorry.
No, it's like the NFL Hall of Fame exists, and I thought that they were going to build an entertainment business surrounding the Hall of Fame.
Yeah, but they have like the proprietary rights to like certain stuff with the Hall of Fame, right? Like they have like Hall of Fame, NFL Hall of Fame, like memorabilia. I think they try to do
they have like
NFL Hall of Fame
hotels and resorts. I think.
licensed like names of players and stuff, and try to do like Hall of Fame NFTs and stuff.
Yep.
But either way, okay, so a hotel, right? Like you have Hilton, you have these other publicly traded hotel companies. This one is just a hotel by the NFL Hall of Fame. I don't know. I mean, Luke, you love football.
All right, wait, and just to close the loop here. So Lottery.com does have board members. It's got 2 board members. It looks like since November.
Hey, the company is getting ready to report lottery in 2 weeks, March 21st.
I don't think so.
Oh, they're not going to do it?
I
Oh,
don't
unconfirmed it. Yeah, it says earnings unconfirmed.
I don't think they filed their last quarter yet.
But I was going to ask, well, actually, Luke, what we should do, we should take a field trip to the Hall of Fame resort. Hall of Fame, check it out.
Yeah, so as of November 30th, they are still delayed on their 10Q, and I have not seen earnings since then. Again, I could be wrong. It's not a super well-covered stock, but that's the dealio.
I was going to ask.
All right, Hall of Fame Resorts, stock price, $1.12.
Okay, it is... Wow! Oh, wait. Hold on. I'm getting 2 tickers on here. One says 9.76, one says 8 cents.
If there's a reverse split, you gotta split
There's
adjust it.
HOFVW.
That's the warrants. That's the warrants.
Okay, so the stock is at
No. Come on. Check for a split. All right, 1 for 22 split. So it's 980 divided by 22. I didn't know it was split. So I was way off.
yeah. But either way,
It's lower. It's lower. So 9.8. So if it didn't have it split, 9.8. Oh, shoot. 9.8 divided by 22. So if it didn't have it split, it'd be 45 cents.
oh, so it's still doing a little bit better. Or no, it's actually doing worse than lottery. Lottery's at 50 cents. But here's what I was gonna ask you. So we're both pretty big football NFL fans. Have you ever been like dying to go to the NFL Hall of Fame?
Absolutely not.
Neither
No,
have I.
no way. Like zero.
But
like
I would,
negative interest.
But I would just to do like a due diligence trip on HUFV, like check out their facilities, see what's going on, like talk to the people there. That could be fun.
If I was retired, I don't know if I would.
But
go.
that's the thing is, I mean, if you're talking to two like huge NFL fans and we aren't dying to go to the Hall of Fame resort, then who is, right? Is it just like retired people that have nothing else to do?
Looking at how far it is.
All right, speaking of, and I know you got to run, Luke, but speaking of resorts.
All right, wait. How far do you think the drive is? Like we've never contemplated going. How long do you think
Cambridge,
the drive is?
Ohio? Is that right?
Yeah. We've literally never contemplated going.
4 hours.
3 hours and 11 minutes.
Let's go someday. Let's pick a Sunday and go. All right, maybe not a Sunday. I don't
Let's
know.
call in sick on a Tuesday.
All right. Yeah, we can't waste one of our like good Sundays. I was gonna say, speaking of resorts, let's go back to a little bit of a bigger company. How you feel about Disney right now?
No opinion, really.
No opinion on Disney. All right, give me a stock you have an opinion on. I'll take whatever. I'll take the opposite side of whatever opinion you give me. Unless I really can't, and then I'll tell you. Or give us.
What about WW?
Okay, so WW Weight Watchers. Company's not called Weight Watchers anymore, but it's like Meta, Facebook. We're still gonna call it Weight Watchers. You can get mad at me if you want. Stock was up. Was this Monday or Tuesday? The stock was up. Oh, it was yesterday. Stock was up 70 to, or I think closed up nearly 80%. Because the company announced it was acquiring Sequence, which is a telehealth company. And essentially what Weight Watchers is trying to do is make it so that you can go to your local Weight Watchers and use Sequence's telehealth company to get prescribed one of these new magic weight loss drugs. There's like 3 different ones out there, Wegovy, Ozempic, and then a third one. I'm kind of upset at myself, Luke, that I didn't foresee this happening, right? Weight Watchers getting in.
I like the telehealth plays. You know what I think is one of the best backs?
Clover.
No.
Oh.
Hims.
Oh, yeah.
That's a decent one, right?
Yeah. I don't use Hims, but I'm on some of the same products that Hims offers.
Yeah, I generally bullish on the telehealth stocks, especially the companies that are technology companies first, not pharmaceutical or medical companies first.
I actually did also when I was first looking into it, used it, and then I found out. So here's the problem with Hims, right? To me, from an overall business standpoint, I'll take you through my timeline and what I did with it. So I initially, I was like worried about losing my hair, all this stuff. Kept seeing the commercials, which Hims does a great job with marketing. I get the Hims app. Within like 10 minutes, they have me face-to-face, FaceTime with a doctor. The doctor's like, yeah, you can kind of start seeing the early signs of male pattern baldness. We can prescribe you all this. And it was like a free first month or a really good deal. And then after that, I was doing some more research. And whatever the price Hims is charging, you can just go out and get the generic versions for way cheaper. So I got all the information I needed for Hims.
Wait, but don't you need a prescription?
Yeah, but I just made an appointment with a dermatologist and then said, hey, I want, generic finasteride. And then instead of having to pay Hims $60 a month or whatever, I go pick up a prescription that literally costs $10 for a 90-day supply. And Hims charges like $60 a month for a box that comes with, that pill finasteride, some Rogaine, which again, you can buy just the generic version. So I think over time, if people realize, hey, I can just do this on my own and it's a lot cheaper, it's basically the convenience play, right? If you have money and you just want the box delivered to your house.
Premium though, because you can't use your insurance with Hims or what? Or is that the price after you use your insurance?
That's a good question. I don't know. I don't think it goes through insurance. I think Hims just sells you their generic Hims version of it, because once a drug's on the market for 7 years, anyone can make it, and so Hims just produces its own. I don't know if they actually produce their own or they buy it from someone else, but you basically get like the pill bottle literally says Hims on it. It doesn't.
Yep.
It doesn't say. So that will be one thing I worry about, is people just realizing and all it did was took me a quick Google and Reddit search for people to be like, yeah, Hims is good, but you can do this on your own and it's a lot cheaper. And I was like, yeah, I'll just do it that way.
Yeah. Okay.
Makes sense.
No, it makes sense.
But I do like.
I
I don't dislike HIMS. I don't think. I just, again, that'd be my big worry about it, is that like is it worth paying that premium just for the convenience of getting the box delivered to your house? I don't know. If we have anyone that uses HIMS in the chat, let us know. But yeah, I mean, Clover. What about Clover? How's that doing? Oh, less than $1. What about Smile Direct Club? That's kind of
It's a tough one.
it's not telehealth, but it's like direct to consumer. Yeah, not doing great. I don't know. All right, Luke. You got more?
Alrighty, sir. Thank you for having me.
Of course, man. We gotta get you back on more. I know the chat.
Deal.
I know the chat. Just buy cadaver hair. I don't want to put dead people hair on my thing.
Yeah, it's
All right, guys, smash the like for Mr. Luke Jacoby, Hot Stocks Luke. If we don't get enough likes, he's not going to come back on the stream with me, and I really enjoy it when Luke's on. So, Luke, enjoy the rest of your day. We'll talk soon.
Peace. Happy trading, everyone.
Alrighty, y'all. Got a couple things to talk about. So we talked about the story yesterday where Elon Musk, right, fired a man kind of publicly on Twitter. Between yesterday's show and today, Elon has since backtracked and said that, apologized to Hallie Thorleifsson, the Icelandic entrepreneur who got brought onto Twitter when Twitter acquired his design company a couple years back. And essentially, I don't know if it was just because he got a lot of criticism, Elon Musk, for this, or it was also, made apparent yesterday that Twitter could be on the hook to pay Thorleifsson $100 million. So Thorleifsson did something really interesting. When his company got acquired, he had an option of how he got paid. He could have taken Twitter stock. He decided to take it in wage compensation. So essentially, once the company was acquired, Twitter was on the hook to pay Thorleifsson $100 million in wages, which means if they fire him, they got to still pay him that $100 million, but he doesn't have to work. So, essentially after that, and there was also the potential that lawyers came in and because Elon said something about his disability and sorry for some context, Thorleifsson has muscular dystrophy, is in a wheelchair, said something about, Elon said that Thorleifsson used his disability as an excuse to not work. And I don't know if it's because Thorleifsson's not in the United States and maybe the rules might be a little bit stronger in Europe, but a lot of people on Twitter and whatnot were speculating that like that could be a massive lawsuit on its own, not to mention the $100 million already owed. And it's a little unclear if Thorleifsson is accepting the offer to come back to Twitter or what's going to happen there. But either way, I just wanted to close the loop there because there was that major development since when we talked about that story yesterday and today. And, I think it's just a sign of some growing disorganization or really some ongoing disorganization at Twitter. I don't really know. I don't think this has any, short-term or acute effects on Tesla's stock. Although I was talking to someone, and this isn't, anything backed up by data or anything. This is just my hunch. This is my personal opinion. I would be surprised if like big money managers, and I'm talking about institutional investors, not retail investors, because retail investors still love Tesla, still love Elon Musk. I'd be surprised if institutional investors aren't looking at some of this stuff that Elon's going on at Twitter and being like, I don't know. If there's not just like a tiny bit of trust lost, a tiny bit of hesitation to essentially invest in a company that Elon is so integral to, right? Because some companies, their CEOs every CEO is obviously very important to their respective company. But for some companies, it's way more important and integral than others. And I would argue that Elon is more important to Tesla than any other CEO is to their respective company out there. I mean, you can make arguments, right? I mean, Tim Cook's been a killer for Apple, right? The Nadella for Microsoft has been a killer, but I guess actually Berkshire Hathaway and Warren Buffett. But even then, even Warren Buffett and Berkshire Hathaway, Warren Buffett's been old for a very long time. Warren Buffett has been setting up a succession plan for a very, very long time. I honestly don't know, like, if Warren Buffett retires or croaks, whatever, like, I don't even know if the stock's going to crash because, again, that succession plan has been in place for a while. There's good people around him. They've been planning for this for a very long time. Elon, on the other hand, if something happens to Elon, whatever, like, God forbid, something happens, whatever, I think Tesla stock would crash because without Elon, I don't know if where that vision is coming from. And I think a lot of investors would start looking at the company more from a fundamental standpoint instead of the speculative what's going to happen down the road, the way that Elon describes things. So again, my hunch is just basically that like the ongoing mess at Twitter, stuff like the Thorleifson firing from Musk, I think it might just leave a bad taste in a lot of institutional investors' mouths when it comes to Elon, just to say like, okay, and that's not to say they're gonna like think Tesla's uninvestable. No, of course. I mean, Tesla's a huge company. It's probably going to continue growing, all these things. But there will certainly be a price that people kind of throw all that out the window, right? Like if Tesla gets down to $100 again, I bet a lot of those big institutional investors are going to say, I don't care what Elon's doing at Twitter, I'm going to buy. But I'm saying up here where the stock's at right now at $180, still trading very, very expensively compared to the overall market, an 8 price to sales, a forward PE of about 50, and in an environment where the interest rates are going to continue to grow. Again, and that's just my personal hunch. That's my take, is that institutional investors are going to look at what's going on at Twitter and just say, okay, we're a little bit unsure about this guy right now. He's showing some lack of either leadership skills, lack of organization, and all of these things. And it's hard to imagine that, okay, Elon runs Twitter one way and runs Tesla a completely different way. He's way more professional at Tesla than he is at Twitter. I don't know. I don't know if that's true. I think he has more guardrails at Tesla, keeping him in place because it's a publicly traded company, and he's got, more people to respond to, and boards and whatnot. Whereas Twitter is at least it seems like he's more treating it like a wild west. But either way, that again, just wanted to close the loop from that yesterday. Another story that I wrote about today, getting a little bit off the path of stocks. Oh, we just had a good suggestion for worst spec that I'm just now seeing from our news desk, Bill. FaZe, the gaming company, I don't even know. Like, oh no. Oh, wait, I thought my Benzinga Pro crashed, but I accidentally hit back and it tried to go to lottery.com, so that's why my page isn't working. Let's just say if I'm trying to invest in video games, I'm not going to do it through FaZe. I don't even know, is it FaZe or FaZe? AT? Bill? FaZe. If I'm investing in video games for the long term, yeah, I 100% agree. There's a lot of money left on the sidelines. The question is, are those institutional investors going to be throwing that money at Tesla or other names? And like you said, NVIDIA keeps running. The way NVIDIA keeps running gives me the impression there's a lot of money on the sidelines, but there's only one company they all feel comfortable piling into. And it's clearly not Tesla right now. Look, Tesla's down 3.22% today in a day where, let's see, the Qs are up 1/3%. So that's something, again, I'm not going to take one day's price action and try to extrapolate too much from it. But on a day where tech is trading slightly higher and Tesla's down 3%, that should show you that there's some relative weakness in the stock. And again, I don't know where that's coming from, but I can tell you it means that there's less demand than there is supply, right? That people are selling the stock. People are not willing to buy it up here. Maybe if it gets lower, people will start being more willing to buy the stock. But right now, it looks like there's some relative weakness in the stock. Again, could be coming from the fact that Elon's showing, some lack of leadership skills at Twitter. It could be coming from just worried about interest rates. But the thing with the interest rates is you would think that would carry over to companies like NVIDIA and other ones. So if those are trading higher today, right, you have Apple trading up almost a full percent. You have Microsoft trading, let's see. Microsoft's actually down today, but only about 0.5%. You have Meta down about 1/3%. Netflix up about 0.5%. So Tesla seems to be underperforming compared to all of these, major tech stocks. So that would just be something I watch out for. Full disclosure, I am holding some Tesla puts right now that expire Friday. So honestly, I would not be mad if Tesla drops another 10% from here on Friday. I'd make a lot of money. Just wanted to throw that out there so people, know my full positions. But anyway, what I was gonna get to, oh, let's see, Yext looks like the next. All right, this is why and obviously, you know, I use Benzinga Pro on the show every day. Pro.benzinga.com for a free 2-week trial. But this is why I love the platform so much. I don't have to go anywhere. I can just stay right on Benzinga Pro. Yext provides a knowledge engine platform that lets businesses manage their digital knowledge in the cloud and sync it to approximately 200 services. So Jay Rice saying it's an AI play. Up 13% today, looks to be trading pretty well. I love that. I love this pattern, by the way. Like, you guys know I'm not the hugest technical chart guy. Like, I'm not going to buy something just based on the chart. If the storyline, the fundamentals, and the chart all work out, then I'll go ahead and hop in. But I usually am not typically buying something just on a chart. If I am, it's typically just for a trade. But I love this rounding bottom pattern. Right, because it shows me a clear bottom, some consolidation, a clear bearish trend, and then following up with a clear bullish trend. And right now, I mean, this stock is in a clear bullish trend. You had it reach $4 back in October, up to about almost $10 today. And if you wanted to get long, I think you could easily set, you know, a little price target like right around $13 and say, okay, I'm buying this at $9.50. But with that said, I'm always wary of buying a stock that's moving so much. So since it's already up, you know, 14% today, chances are, you know, could be due for a little pullback. That's what we saw with Weight Watchers, which I don't know how Luke and I got distracted from Weight Watchers, but essentially, Weight Watchers was up 80% yesterday, closed up 79%, down 22% today. That's a normal reaction, right? A stock goes up 80% in a day, seeing it come down a little bit the next day, not that surprising. So what I was gonna talk about a story that I wrote today that's getting us a little bit off the beaten path of stocks, into the sports world, but it relates to money, so I want to talk about it. So right now there's a lot of talk about Lamar Jackson's contract. So the Baltimore Ravens quarterback. So first of all, the Ravens used a non-exclusive franchise tag on Jackson yesterday. A franchise tag is a designation a team can give a player who would be going to free agency that then gives the team the right to keep that player for one more year, as long as certain conditions are met. So I think the franchise tag in the NFL means that if you franchise tag a quarterback or whatever, it doesn't matter the position, you have to pay them like 120% of the average of the top 10 highest paid players in that position. So you got to take like the top 10 quarterbacks in the league and then use the franchise tag on them. And then the non-exclusive means that Lamar can still go around and shop himself out there, look for other deals from other teams. If you use an exclusive tag, they can't do that. Baltimore Ravens will actually end up saving about $10 million if he does end up staying by using the non-exclusive tag versus the exclusive tag. So in a quick storyline of what's happened over the past couple of years with NFL contracts, especially for quarterbacks, and here's one note as well that makes NFL contracts very different than other sports contracts like NBA or MLB contracts. Most money in NFL contracts is not fully guaranteed. The contracts essentially require that players stay healthy and play the games. Otherwise, they're not going to get their full contract. Obviously, if you're a player and you're playing a really dangerous sport like football, you might not like this because you're going out there and getting hit all the time. And you know, okay, if I just take one bad hit to the head, I'm out for 6 weeks and I'm going to lose all this money. That's not fair. So Lamar Jackson, because he's one of the top players in the league, is trying to get essentially a fully guaranteed contract. Now, there is the precedent for this because a couple years ago, or actually last year in March, Deshaun Watson signed a $230 million fully guaranteed contract with the Browns. Now, a lot of people look at that as a very terrible contract. Deshaun Watson was suspended for the most of the season last year and didn't play great when he came back. But more so than that, people are, I guess, like the owners are worried. Cannot they buy insurance? Yeah, I think they can. but I think the idea is that they would like it to just be baked into their contract, and other people are getting fully guaranteed money. So Lamar wants fully guaranteed money, but Lamar is basically looking at the Deshaun Watson contract and saying, hey, I'm as good as him. I'm not going to be suspended for as many games as he is. I want that type of contract too. And the Ravens have been pretty, hesitant to give him that contract. He's had some injury issues. Whoa. He's had some injury issues and whatnot. But now what we're seeing are teams are passing on Lamar Jackson. So the multiple teams, including the Atlanta Falcons, Washington Commanders, and Carolina Panthers, have indicated they will not pursue Jackson. Why pass on Jackson? According to Fox Sports, Jackson is seeking a contract around $230 million, fully guaranteed. Most NFL contracts are not fully guaranteed, and are dependent on players staying healthy and playing games. Jackson also famously does not have a sports agent and has chosen to negotiate his contracts himself. Many people are speculating this is making it more difficult for him to secure the deal. So I do want to talk about this for a second because all right, I know a little bit about sports agency because my father was a sports agent. His father was a sports agent. And honestly, I know what they do. They negotiate your contracts, but if you sign like a 6-year contract, your agent's really not doing a lot for the next 6 years after that, right? Like they help the players, you try to find more endorsements, whatever. And so for a player like Lamar, who has a lot more leverage than say like a, second tier wide receiver in the league or something, when you're a premier quarterback in the NFL, you have a lot of freaking leverage. I honestly don't think it's the dumbest thing that Lamar is representing himself. I think a lot of people are speculating this is making it harder for him to get a new contract, that he doesn't have someone with experience negotiating these deals and whatnot, because the idea is an agent would essentially lay out a whole thesis and presentation as to why Lamar deserves the fully guaranteed money. They'd pull up comparisons and all this. And I don't know, what Lamar is doing other than saying, hey, Deshaun got that. I'm as good as Deshaun, if not better. I want that money. But if you think about it, I mean, an NFL agent gets paid 3% of a player's contract. So if Lamar signs a $200 million contract, that's $6 million going to an agent. That's not nothing. $6 million is a decent amount. A lot of people would probably say, hey, that 3% is nothing. I mean, Jay, I said I was gonna get off stocks for about, I don't know. We've been on this for 5 minutes. It was an article I wrote today, so I wanted to talk about it. And it's a money show, a finance show, and this story is revolved around money and the finance. And then we'll get back to my stocks and options trades in a minute. So basically, I think a couple things are happening. I think the owners of the NFL are saying, okay, the Browns screwed up by giving Deshaun Watson a huge fully guaranteed contract because now other players are asking for this fully guaranteed money. They don't like those contracts. It's not good for the owners. It's good for the players. So if then Lamar gets the fully guaranteed contract and now it's the second big quarterback that's gotten it, then that becomes the norm. That becomes the precedent that big quarterbacks and players can get their fully guaranteed money. And I don't think the owners want to do that. So I think there may be, I'm just speculating here, some like behind the scenes talking about, okay, how can we make sure that this fully guaranteed thing doesn't get out of hand and we can keep our contracts the way they were. That's one side of it. I think there's another side of it to where teams might like dealing with agents. They have their relationships, whatever, and they might be trying to kind of punish Lamar for saying, hey, you try to do things differently. You try to do things on your own. Let's see how it works out for you. So, the money's out there. I mean, Giants just signed Daniel Jones to a contract about $40 million a year. Deshaun Watson, again, got a 5-year, $230 million fully guaranteed contract. It's an interesting story. I don't know what's going to end up happening. But anyway, never invest in sports teams, whatever. Yeah, I don't even know. Like, I don't think there are actually a couple sports teams that are publicly traded, right? You have Man U and whatnot. I'll take a second real quick just to walk through some of my open trades I've got going on right now. I did mention those Tesla puts that I'm holding. I bought some BABA calls yesterday just because I thought, that the stock was getting a little bit overextended to the downside. If you look, I mean, this was an $120 stock as little as, 6 weeks ago and is now back down below 90. The chart looks like we could be looking a little head and shoulders-y if we get in a little boulder shoulder here. And so if we get a little bounce here up to about $95 or so, then maybe I'll go short on the downside there. So my BABA calls not working out for me, down about 77% on those. I bought these Tesla puts yesterday though. Those are up about 89%. And it's actually been a good week for me on the account. You can't really tell from the value because I pulled a lot of money out of the Robinhood, but in the past week, up about $2,200. So yeah, I'm back in the options game. I'm back trading options. Had a hot week, up 2,200. And what I actually take pride in, and I just said the same thing. What I'm proud of this past week is that I did it on both sides. I bought SPY calls last week when I thought we were getting a little overextended to the downside. That's this big jump here. I bought calls on the day before the SPY went up 1.5%. Last Thursday is when I bought the calls. Friday was a great day. Made a lot of money that day. And then this week, I bought some SPY puts and made more money. And typically, my big problem is that I get too, kind of tunnel vision where I'm either bullish or bearish. And again, I'm proud that I was able to play both sides. And I've been talking about why I think you need to be able to do that in this market. Because the way I see it right now is there's a floor and a ceiling for the overall market right now. The floor, what's going to keep us from crashing, what's going to keep SPY from going back to 350 or crashing, is the fact that the underlying American economy has been strong. Unemployment has been really good. People are still spending money. And as a result, inflation hasn't fallen that much, which is just the bad side. The ceiling is that the Fed's going to keep raising interest rates. So if you take a look at a SPY chart and you see where we were at in, January 2021, when we were at all-time highs, or I guess December 31st, was that the all-time high? Really? I mean, this is a Robinhood chart, so it's a little shitty compared to Benzinga Pro. But I don't think SPY is going back to 475 anytime soon in a high interest rate environment. I think there's I think we could still be bullish. We talked about this with Mike yesterday, Options Mike. But again, a lot of people out there calling for a crash. I saw another guy on Fox Business today saying not only does he think the stock market's going to crash, he thinks it's going to happen in the next 60 days. I ain't buying it. I ain't buying what the doom and gloomers, what the perma bears, what the, oh my God, the market's crashing, the sky is falling, are selling, because those people aren't paying attention to the economy, in my opinion. They aren't looking at why the Fed's able to raise interest rates so highly. They're not looking at, what's going on with the overall economy. They're basically just looking at interest rates. They're looking at the real estate market, and I get it. There are some signs out there that I would say, indicate that sentiment's a little bearish right now and whatever, but I've talked about it before on the show, how I kind of like to fade the general public a lot of the times. And you can see here, look at this. Look at this. A month ago, 37% of retail investors were bullish. Only 25% were bearish. That's completely flip-flopped in a month. What's happened in a month? The Fed's saying they're going to keep raising interest rates. Again, the Fed's only keeping raising interest rates because the economy is strong. And I know that the higher interest rates will make people more likely to buy bonds and treasuries and less likely to buy stocks and whatnot. But at the end of the day, a stock market crash is usually coupled with a recession or a big downturn in the economy. And we might see that, but it's going to be like a calculated, engineered downturn in the economy, not some, 08, something broke, or COVID crash, this new pandemic came. It's going to be, hey, we're slowly going to bring unemployment up until inflation comes down, and then we can start cutting rates and unemployment will start going, or sorry. Unemployment will start going up, inflation will start going down until we hit that equilibrium point, and then they'll start cutting rates, and then unemployment will start moving down again. And I'm fine, so yesterday a lot was made about Elizabeth Warren's questioning on Jerome Powell, because Powell talked about how there might be pain in the labor market. And if you missed it, essentially Elizabeth Warren was like, so, our data shows that as interest rates get up to X, 2 million people will lose their jobs. 2 million Americans will be out of work. We're just supposed to tell those people, yeah, that's fine because we got to bring inflation down. And Powell's basically like, yeah, I mean, is it better for working class people that inflation stays high or that some people get laid off? Elizabeth Warren got a lot of criticism for this line of questioning. And I get it because she's kind of polarizing. I'm not a big fan of hers at all, but I kind of got to back her up here because they don't say that. Jerome Powell doesn't say that. The Federal Reserve doesn't say that. And they have the same data available that she does. So if she's looking at data that's showing that 2 million people will lose their jobs as interest rates here, the Fed knows that. So why not just say, hey, X amount of people are going to lose their jobs and we got to get inflation down to 2%. Instead, they try to, Powell tries to, I guess, talk around it. And I understand why doing so, because no one wants to hear, yeah, we're going to bring unemployment higher by raising interest rates, but people also don't want high inflation. So I'm in the camp that I think, as long as inflation's not going higher, even if it's just staying at 5%, right? You keep inflation at 5% for a year, then by year over year, you're at 0%, right? If prices are steady, but if we see that year over year inflation start ticking higher again, that's when the Federal Reserve might agree. I mean, the Fed caused inflation with QE for 10 years. Yeah, and I mean, you can talk about the politics of it because I think it doesn't matter Democrat, Republican, who's in office. Whoever's in office wants the market to do well, right? So I don't think there was a lot of pressure from Obama post-Great Financial Crisis for the Fed to start raising interest rates. There certainly wasn't a lot of pressure from Trump to start raising interest rates. In fact, there was the opposite. And so, I hopefully when it's all said and done, the Fed can learn its lesson and say, okay, when things are going really well, we can start raising interest rates slowly. I think another thing you have to keep in mind, though, is that certain times we were in a deflationary environment, which brings its own economic problems. So either way, I think just because what I didn't mind essentially about Elizabeth Warren's questioning, even though it got a lot of criticism, was that she basically is forcing Jerome Powell to say, yeah, we are going to tolerate this amount of unemployment. We are going to tolerate, say, a mild recession or whatever to bring inflation down, which is fine. Yeah, it's all central banks, but I mean, I think a lot of central banks just kind of look at what the Fed does. Honestly, I think that's a very, and I'm kind of being sarcastic here because it's not obviously that easy, but I think if you're on the Federal Reserve of a lot of other countries, assuming your country is not going through some weird thing like when Britain had the pound fall in 20% or whatever, or some crazy thing, I think a lot of central banks just kind of look at what the U.S. is doing. Obviously, Japan's different. Japan's been doing shit differently for a very long time. But Japan's proof that you can have a low interest rate environment for a long time without seeing runaway inflation. So again, that's what I didn't mind about the Elizabeth Warren questioning. Is just that Powell doesn't, why not say that? If that's the point, to put X amount of people out of jobs to get inflation down to X, why not just say that? Why give us the runaround? And he kind of does, right? If you read between the lines, he's like, yeah, there might be pain in the labor market as we raise interest rates, yada, yada. But it's Europe haven't even started raising for real yet. I don't know. I mean, I think basically all the major central banks around the world have started raising interest rates. Maybe not to the extent that we have, but I mean, is there an easy way to check interest rates. Holy cow. I mean, look at this. Japan is still at negative interest rates. UK's at 4. We're at 4.75. Canada's at 4.5. Euro area is at 3. Okay, so you're right. I mean, Euro's keeping their interest rates a little bit lower than expected. Chart of Japan inflation. $25 years. I just don't know. I mean, for like all this time up until right here where my cursor is, and it started to really go higher. I mean, you have these like swings in inflation. How does Japan keep inflation so low with low interest rates? I think the idea is that, and this is kind of like an MMT, modern monetary theory idea, that you keep interest rates lower, it spurns growth, and that growth then leads to natural deflation, right? It's something kind of Kathy Wood talks about. And I know all these things are kind of dirty right now and probably don't hold as much weight, but I do think there's some truth to it. You look at, say, even in the U.S., like price of TVs over time, United States, like things like this where you have growth in the industries, like this is the inflation of television. So basically it's this idea that over time, as technology advances, which it advances quicker in a low interest rate environment, when companies can invest more, when countries can invest more in technology, that it actually helps bring prices down in the long run. And if you look at it, something like, semiconductors, I think a lot of people are worried that, okay, how, the semiconductor shortage was a huge driver of the initial uptick in inflation that we saw a couple years ago with COVID. And if you essentially make it harder for NVIDIA and AMD to grow and to produce more chips, then that supply is going to remain lower of chips, thus keeping the price higher. When the idea of the MMT, Stephanie Kelton, Kathy Wood camp is that if instead you give these companies a lot more money to invest and essentially, turn the money spigot on, then NVIDIA is building new factories, producing a lot more chips, thus bringing the supply up, and then going to bring the price down a little bit. All these things are just theories, and I think I don't know how well they hold up over time, because I don't think we've really tried it at scale here in the United States. I think for a while after COVID, we did see a lot of growth from QE without inflation. And then I think, a lot of these kind of outside factors, whether you look at higher semiconductor prices and shortages that cause car prices to go higher, bringing inflation higher, whether you look at a shortage of housing causing rent to go higher, whether you look at, the Russia-Ukraine war making energy prices higher. I think if you take some of those factors out, we're having a very, very different discussion about, holy cow, how did we add all this stimulus to our economy and yet inflation isn't running away? So again, all these things are just theory. I think, people look at what's happened with inflation and say, okay, that's just because the Fed had interest rates too low and we had QE and the monetary supply was artificially inflated. I don't think that's necessarily all true. I think that's a major factor and probably the biggest factor. But you got to look at these other things like the semiconductor shortage, the Russia-Ukraine war, the housing shortage in the United States, and realize that those have impacts on inflation as well that have not that much to do with interest rates. Sorry, people were saying Aaron. I don't know if they were talking to me or AT. Alrighty, y'all. Any stocks in the chat we want to check out? We might jet a few minutes early because I've got a Italy, Spain, Portugal, Greece would break my friend. Be aware. We'll be back tomorrow. So tomorrow we're actually this reminds me, I've got to remind some of my team here, Midge. FYI. All right. We'll be back tomorrow. We're actually going to start the show a little early tomorrow, 11 a.m. We're going to bring on Aaron Herrera's from Glassdoor to do a little preview of the jobs data on Friday, which, again, like, basically the whole market comes down to jobs data and inflation right now because, you know, jobs data, if that comes in hot again, which we had ADP, the private payrolls today, but ADP, I don't like to take too much weight in that just because there's always a lot of revisions and whatnot there. Whereas the numbers coming out on Friday, I think, you know, the market takes it a little bit more seriously. So we're going to bring on Aaron Herrera's to do a little jobs report preview tomorrow. Someone talking about Coinbase. I wouldn't be touching Coinbase here if I were you. Well, it depends. I mean, it depends on if you're talking about trading it or depending on if you're talking about just buying it for the long term. I just don't see Bitcoin, crypto really coming back that heavily in such a high interest rate environment. Because, I mean, you think about it from a very rudimentary standpoint. People are willing to take more risk, more speculation when interest rates are lower. People are willing to take less risk and less speculation when interest rates are higher. Crypto is about the most speculative risk asset out there. And you could argue with me that, okay, Bitcoin, not so much because it, you know, has kind of found a floor and been trading around, you know, whatever. But I would just still really worry about a Coinbase here. And in fact, I think I might take this opportunity anytime I see Coinbase. The problem is like options and puts and stuff on Coinbase are just always so expensive. Yeah, long term's a different story. But I still like, you know, I still, even if I loved Coinbase long term, I would maybe wait just because, like, and again, it might not matter if you buy it at 60 and hold it for 10 years, then it's at 500. It's not going to matter that much. But like, if I think Coinbase is going down to $40, say, like, why would I want to get in long term now when I can wait? I would just be shocked to see crypto roaring back and thus Coinbase like having a great, you know, next 6 months in such a high interest rate environment. I just don't foresee it happening. And I could be very, very wrong because I've been very, very wrong before, and I'll be very, very wrong again. And I'm currently not long or short Coinbase. Like I said, if I see Coinbase like up 20% in the next like 2 weeks and it's at $80, then yeah, I will start looking at some like long dated puts. But right now I have no thoughts on it. Of course, man. Appreciate you. Appreciate everyone that tuned in today. Please smash the like, subscribe to the channel if you have not already. Again, we'll be back tomorrow a little bit earlier than normal. Peace and love, y'all.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trends